Everyone is talking about the AI bubble and how its inevitable pop will trigger a stock market crash worse than 2008 or the 2000 dot-com bubble. But nobody seems to be getting as excited as I am for the huge wealth-building opportunity that will bring. Let me explain what you need in order to be ready. Guys, here's what I'm seeing right now, and it's not just me. MarketWatch, CNN, New York Times, even the freaking Yale economists are sounding the alarm. They're saying this next crash could be worse than anything we've seen, worse than 2008, worse than the dot-com bubble. Right now, AI is the hot thing. Every company is throwing words like artificial intelligence and AI into every single press release over the past 2 years just to get their stock to pop. Does it sound familiar? Well, if you're not old enough to remember, this is exactly what happened in 1999 when every business was suddenly a dot-com overnight. And guess what happened after that? Boom, total collapse. But here's the part that most people miss. After the crash, after the hype dies, that's when principle-driven investors like you and I make the real money. That's when prices go from stupid to sensible and then stupid on the low side. And this crash could be your once-in-a-decade opportunity. Guys, I want you to remember, just like we can be stupid high, we can be stupid low and stupid cheap. That will probably happen at some point in the future. And when it does happen, I'm going to remind everybody of the videos of 2025 when I said things were stupid expensive. Everything goes in cycle. Death, tax, cycles. These are 3 guarantees in this world. But let's talk about what's really going on. And in this video, I'm going to also give you some simple, actionable steps that you can apply today. Guys, here's what I'm seeing right now. CNN just covered a report from a big research group, and they're saying the AI bubble, all the hype and money flying into artificial intelligence, could be 17 times bigger than the dot-com crash in 2000 and 4 times worse than the 2008 housing crash. That's not just bad, that's massive. Now, I want to remind everybody, this means in terms of dollars, not in terms of, obviously, if the market fell 55% in 2008, we can't go down 220%. It means in total dollars. Now, one thing I want to show you guys from this article that I find to be very interesting. Just this week, the Financial Times wrote that 10 AI startups, not a dollar in profit among them, have gained nearly $1 trillion in market value in the past 12 months. Guys, this is exactly like the dot-com bubble. We were talking before, we were talking about bubbles, and it's like, well, AI, NVIDIA makes real money. And for a long time, it was, hey, AI is real. But guys, look at ChatGPT. This is a company valued at $500 billion, and it makes no money. It loses massive money every single month. And companies are throwing billions at AI. They're spending insane amounts of money to build out these systems. But the truth is, the more money they spend, the less they're getting back with these companies. At the same time, businesses are racing to build giant computer centers, hire tons of people, and throw the word AI into everything they do. But here's the problem. The profits aren't there, not yet. Just like back in 2000, the profit wasn't there, not yet. But these companies are making very big promises. But usually, guys, when there's a lot of hype into something and a lot of big promises are made, it's hard to really keep up with those. This report even warned that if things don't improve, we could see a full-blown economic meltdown, not just in tech, everywhere. They used a scary term for it, a deflationary bust. That's just a fancy way of saying everything could collapse. Stock prices, jobs, even parts of the economy that we think are safe could collapse. Now, guys, again, I want to repeat. I'm just reporting what's out here right now. Do I think the market is massively overvalued and AI is a bubble? Absolutely. Do I think it's going to pop? Yes. Do I know when it's going to pop? Absolutely not. I wouldn't dare say that. But the point of all of this is to teach a principle-driven approach to this. Now, for the market, the worst part is I don't think people really see it coming. Now, yeah, we see a lot of people talking about AI bubble. We are in the everyday 24/7 news cycle versus 25 years ago, we didn't have access to social media. People are still chasing hype. People still think that AI can only go up. But I want to remind everybody that AI will be beneficial to everyone in the future. But I'm already seeing people starting to slow down on their conversations about AI within companies. I literally, before I came down here right now, had a conversation with somebody in my office upstairs in which they said, I'm sick and tired of everybody just relying on AI for everything in this office. And I joked and said, well, if we just need AI, why do we have anybody here? I truly believe that at some point in the future, companies will brag about, we are not going to respond to you with AI, you're going to have a human here. Yes, AI is going to be important for doing a lot of things, but I think the human interaction is not going to be as big as people think in terms of replacement. People value talking to somebody. Imagine when you call up a phone, some sort of service, customer service. Do you like it when a non-human comes on? No, you're like, operator. If you're like me, you're hitting 0 and operator all the time. There's another warning, and this one comes straight from the New York Times. The piece lays out how the AI boom might not just fizzle out. It could explode in reverse. Everyone's been so busy cheering AI revolution that hardly anyone is asking what happens when this thing doesn't deliver on the high promises. Here's what the story paints. Right now, firms are treating AI like a golden ticket to huge profits fast. But the actual results? They're lagging. The technology is growing, but the payments, the efficiency gains, the real business value, that's still missing. Now then, the article turns to scale. And holy smokes, the numbers are insanely scary there. It points out that if all this money chasing AI hype doesn't find solid ground, we could see a crash so deep that it drags more than just tech stocks down. For the record, guys, when we have a crash, it will drag everything down with it. Tech will probably be hurt the most. Why? Because tech has seen the biggest gain along the way. The market's up over 55%. The Nasdaq's up over 55% since April 8th of this year. Remember back in 1999, 2000 when the Nasdaq doubled in 6 months? Yes, this isn't doubling in 6 months, but it's probably 60% or more by now. If that happens, guys, it will pull chunks of the economy with it. Think lost jobs, wasted capital, failed projects, and the kind of downturn people thought was long gone. The shocking part? This article says that most folks don't even believe it could happen. They assume AI gains are inevitable. They assume the next chapter is just more up. But this piece warns, what if that assumption is wrong? Guys, before I get to the next article, I want to repeat. We as principle-driven investors can believe a story is true, but that the hype is too much, that the assumptions are too great. That is the point of being an investor. Now, guys, I just read a piece from 2 Yale professors, and I have to be honest, it should concern you. They laid out how this AI bubble could burst. And after reading it, it's hard not to feel the pressure building. Right now, some of the biggest tech companies in the world like Microsoft, NVIDIA, OpenAI are all connected in massive waves. These companies are investing billions into each other. They're building AI systems together. They're sharing money, betting big on the same dream. That doesn't only sound exciting, it is exciting. But here's the problem. If they're all tied together like this, what happens if one stumbles? Could it be a domino effect that brings down others with it? The article also showed just how much of the stock market's recent growth is riding on AI. Since the end of 2022, AI-related companies have made up 75% of the S&P 500's growth. They've driven 80% of earnings growth and 90% of business spending growth. That's wild. It means the entire market is leaning on one thing, AI. That's dangerous. That's what we call hype. And here's what's even more shocking. One study found that 95% of companies using generative AI like ChatGPT made 0 return on their investment. And if that's not enough, the technology is moving so fast that companies are spending billions to build tools and systems that might become useless before they ever make a profit. If one of them slips, it might not just be a dip, it could be a crash. If the hype fades and the profits don't show up, this whole thing could blow wide open, which again, should be an opportunity for principle-driven investors. I don't want you to look at this video and feel fear. I want you to look at this video and feel opportunity. Over and over again, I'm going to say that. This is what I wait for every single day. When can I get the opportunity to buy stocks at better prices? Well, unfortunately, that requires stocks go down. But once you reframe how you think about things, that is the opportunity that you will see. And most people don't see it. They still chase hype. Guys, we saw recently in the Nasdaq, 34% return came from companies that didn't even have revenue. Guys, the Mag 7 has driven this market to no end. That's all great and dandy, but these are the things that happen during bubbles. Have I been calling for overpriced market for a while? Absolutely. And I will not back down from that. I am not embarrassed by that. I embrace that because guess what? I don't know when it will end. No one does, but just because it hasn't ended yet doesn't mean it won't end. I've been saying for a while this felt like 2000. Why? Well, mostly because it was attached to a story of technology. That's where I was sitting there going like, this is changing the world. I'm like, okay, well, every bubble is based on something changing the world, essentially. Now, in 2000, we had companies that just had an idea of .com. I remember watching Conan O'Brien, and this guy from 90210, I think it was Luke, was it Luke? I don't remember the guy's name, but he said, hey, I've gotten on the .com craze. And Conan's like, oh, what's the deal? What is it? He said it was plastic protectors for your locker. So he created this business, but he said it was a .com business because he sold it on a website. And I was like, how is that a .com business? It's just a business that sells a product, happens to have a website. That's it. Now I compare that today with AI, and I hear people saying like, oh, our AI machine calculates this. I'm like, you mean it's a calculator? Like, it's not an AI machine, it's a calculator. Oh, our AI does this. Like, no, that's just called programming. Now, this is exactly why I share on YouTube and why I teach on YouTube. I sit there and look at these things in a certain way and say, we've got to ask the question of why. If we just accept the world for what it is, then how are you going to make any difference in what you invest and how you think about that and how you feel about the world? Now, back to the New York Times article for a second. Jason Furman, a top economist and former advisor to the White House. And I want to keep in mind, guys, I don't think very much about people who make predictions, but he's waving a big red flag and he's backing it up with numbers that go way back. He's using a Nobel Prize-winning tool from Robert Shiller, one of the smartest minds in economics. He wrote a great book called Irrational Exuberance about the 90s tech bubble, and then also included real estate in there. So let me explain it very simply. There's this thing called the Shiller cyclically adjusted PE ratio, the CAPE ratio. All it does is it takes the last 10 years of earnings on the S&P, brings it to today using inflation, and divides the current price by that. So what it's trying to do is, if the S&P 500 earnings go like this, get rid of the fluctuations and bring it to a stable point here. Make it a 10-year PE. It smooths out the short-term ups and downs. It gives you a long-term picture of whether stocks are cheap or stupidly expensive. Back in 2000, we got to, I think, 44. The historical average is 16 to 17. So you hear that go, oh my God, 44, that's obviously overpriced. Guys, as of making this video, it's 40.58. It's within 10% of that all-time high. And what happened to the S&P for the next 10 years after it hit 44? It was negative. That means, what this means right now is investors are paying 40 times the average inflation-adjusted profit for the last 10 years. For every dollar of earnings, every dollar of profit, people are paying 40 bucks. That's a massive number. How massive? Well, guys, it's only been this high once before, and that was in 2000. Even the 1928 crash that caused the Great Depression wasn't even close to that high. Furman's point is very simple. If the cyclically adjusted PE ratio, the CAPE ratio, is screaming danger, louder than it has in nearly 150 years of market history, maybe we should listen. Maybe this isn't just optimism. Maybe it's delusion. Guys, I am extremely optimistic about the future of the United States and the stock market from a long-term perspective. But I've always said the next 5 or 10 years in the market probably won't look as good as people think, and it'll be a bumpy road. Furman takes it a step further. He says, okay, even if you ignore that market-wide warning of 40.58, let's look at individual companies. Some of these AI-driven businesses, including the giants, are being priced as if they're going to grow like a tiny startup. Guys, remember, if you have a company that has $1 million in revenue and a company with $100 billion, which one can double their revenue tomorrow much easier? But these big companies are being priced like they're this tiny startup that's just getting going. It can happen when you're small, but when you're already a $1 trillion company, that's a very different story. He's basically saying these companies are being valued like they're going to pull off a miracle. We've been talking about that for a while, guys. But for that to happen, not only does the tech need to work, which isn't guaranteed, they also have to figure out how to make real profits from it. Guys, they haven't done that yet. The only people making big profits from AI right now are the companies supplying AI with the data centers and the chips and the energy. Now, the 10-year cyclically adjusted PE ratio is one of two ratios that we use. The other one is the stock market to GDP ratio, which Warren Buffett calls the most reliable metric at any given time, and it makes sense. As your US GDP grows, the companies within it should grow along with there. So over time, there should be a ratio. Guys, we are 126% overvalued. That is massive. Now, guys, it's easy to sit there and say, well, it's different this time. And you might not say those words exactly. And by the way, for the record, it feels that way with me. Every single day, new all-time highs. I'm like, man, is it just different this time? Are people just okay paying 40 times the 10-year earnings? Maybe. Now, I will say this goes back 100 years, and every single time there's a bubble, it's based on a new technology. Now, the technology's changed. It might have been radio, TV, computers, internet, AI. For a while there was electric vehicles. These are the things I want to remember. It's always a new technology that's changing the world, because every single thing I've mentioned right now changed the world. That's the point. You might sit there and say, yeah, but Paul, AI is different. It's way bigger than cars. Okay, maybe. Quite sure right now, if we lost cars, people's lives would be very, very different today. But anyways, going back to this, in the last 100 years, exactly 400 quarters, the average 10-year return, not including dividend, was 6.4% per year. Now, I look back at all the data from undervaluation to overvaluation, and look what happens. 10.7 undervalued at 30% or worse, and it gets worse and worse and worse as we get overvalued. Doesn't that make sense? It's logical that the more you pay for a stream of income, the lower your return's going to be. It's not coincidental, guys. And we have 400 quarters of data here. Right now, we're 126% overvalued. We just crossed over the 3,000 fair value mark on the S&P, which would be a big drop from today. But guess what's going to happen? If the drop takes 3 years, this value will go up. So you've got to remember, it's a balancing act. We will get to an undervaluation at some point. That has to happen. That's just what things do. That's what an average is. You can't always have every number be above the average. So what we have right now is a market price near all-time highs on nominal levels, actual pricing, but also relative to earnings. That's the fundamentals. That's valuation. Price is one thing, value is another thing. Right now, price and value seem to be like this. A lot of people feel like it's like this, but it seems to be like this. Now keep in mind, guys, I'm still buying monthly ETFs. I'm still buying individual stocks because I do believe that you can find value even in overpriced markets. But you don't need to see a PhD to see what's going on here. You just need to ask yourself, are we paying too much for too little? Are we paying too much for a lot? It's possible to pay too much for a very good thing. Now remember, we're not here to sit there and say, let's get out. This is terrible. That's not the case here. What I want to teach here is, guys, you don't know when the next bubble is going to occur, but you got to ride that wave along with it. And I'm trying to warn you that be okay if the market doesn't do well for the next 5 or 10 years. We will have a crash at some point. The question is when. I don't know, but I want you to remember these conversations, these videos when that happens. We will be the voice of reason during those times. If you're the kind of person that thinks stocks being overpriced high is a great thing and low is a bad thing, I would sit there and ask you, when you go to the store, do you go to them and say, hey, I know this shirt's $100. Can I pay $120 for it? No. You get excited when the $100 shirt's on sale for $50. So we've talked about how big this bubble might be. We've looked at the numbers. Now, what do you actually do? What I just talked about. Dollar cost average and a low cost ETFs. Don't stop doing that. We want to welcome crashes here. We don't want to fear them. That's our opportunity to buy when things go on sale. That's when real investors go shopping. That's when they go to the store and say, look at that sale rack. It's huge. Right now, there's not much in the sale rack. At some point, it'll feel like a going out of business sale. The US economy is ending. Everything is terrible. That will happen at some point. We had it for COVID. We had it for the great financial crisis. These things always happen. The market crash for disciplined investors is exactly the going out of business sale that we want. You don't need to time anything. You just need to be disciplined and you need to be buying as it goes down. You have to remember, companies in the long run go based on their fundamentals. In the short run, the stocks are a voting machine. In the long run, they're a weighing machine. A calm, steady plan works, especially when the world feels like it's falling apart. So stick with your $500 a month, $200 a month, whatever your number is per month, stick with it. Buy low-cost ETFs because at the end of the day, you don't know where the market's going to go in the future. You have to be involved with it. When you buy these low-cost ETFs, you're buying a basket of the US. You're buying, for example, VOO or SPY. You're buying the 500 companies of the S&P 500. Now, there are other ETFs like QQQ, which follows tech stocks, which can do awesome. They're more overpriced right now. That's okay. The story I always tell people is in March of 2000, QQQ hit an all-time high and went to fall over 80% from there. But if you started dollar cost averaging at the very peak in March of 2000 before it fell 80%, you would have made over a 14.5% return annualized right now. Even if the NASDAQ falls 50% from here, it's still double-digit returns. which is way higher than the S&P 500. So when the market crashes and everyone else is freaking out and selling, that's when you can add more if you feel saucy enough. You step in, buy more shares while they're cheap. Warren Buffett said it best. Be fearful when others are greedy and greedy when others are fearful. But do me a favor. Understand what that means, because I see everybody in the world using those terms and then not doing it. I love when the crypto bros all criticize Warren Buffett for not understanding, but then they quote him here when crypto goes down. Your brain will scream run because everything around you will be fearful. But if you follow your plan, if you stay calm while others are panicked, if you keep watching this channel, you will stay calmer. And for the stock pickers, I repeat over and over, focus on value, not price, not hype. If you like picking individual stocks, this is where real discipline shines. Crashes don't just take the junk down. They take down everything, including great businesses. But here's the key. The junk stays down. The good stuff, the profitable, cash flow generating, well-run companies, they bounce back. And when they do, they bounce back with even more strength and even more power. Buy the great companies like Microsoft, Google, Adobe, all these great companies, not even just the tech ones, all the good companies, Costco, when they're a lot cheaper. Make a watch list. You know the companies you want to own. Go put it in our stock analyzer tool and figure out the right price to pay based on fundamentals. And when they go on sale, you're ready. You don't panic, you act. This is how everyone who's wealthy builds wealth. Through crashes, through recessions, through uncertainty. Not by guessing, by preparing. This is your edge. It has nothing to do with timing the market. Your edge is clarity and knowing what you're buying and having the patience and willing to wait for great prices. Now, guys, principles are what keep me from getting sucked into the noise and the hype. Instead of panicking over every price move, as I said before, I stay focused on the only thing that matters, the difference between price and value. And this is why principle-driven investing matters so much. It keeps me from falling into the emotional traps that will ruin most investors. When prices swing wildly, emotions tell you to chase when it's high and panic when it's low. But the principles of principle-driven investing remind me that the market is just an auction, and price isn't the same as value. In fact, guys, I encourage you to look at one thing here. Pull up your favorite company in our community, in our software. Look at NVIDIA. Let's look at 1 year chart. High of 195, a low of 86. If this doesn't prove to you that in the last 1 year, this company has doubled or fallen in half, whichever way you want to look at it, in 1 year, come on. If you don't look at that and realize that's insane, then what is? Let's look at 6 months. 104 and 195. In a 6-month period, it's almost a 50% difference. Now, for a lot of people out there, you look at this and think this is exciting. Exactly. It's exciting when you bought down here. But in order for it to get down there, the story in the public has to change because news follows the stock price. That's what you have to remember. This is exciting. I get a lot of excitement from this. Why? Because I look at it going, oh man, this company could be selling a lot cheaper very soon. Look how much it changed in 6 months. A lot of people would look at this and say, oh my God, this is a terrible chart. Look how much the stock fell. Guys, guess what? This is NVIDIA at the end of 2022. It was at $12 a share. This is why you cannot look at the stock price movement to determine if you're right or wrong. Because if you sat there and looked at this and thought, this is a terrible company, look what you missed out on. You missed out on this. Don't follow the stock price. The same people will sit there and say, oh yeah, but look, the stock is down so much. Or hey, I'm right because the stock is up. Okay, but what does matter? The long-term fundamentals. By sticking to my process, I avoid those knee-jerk reactions. I don't care if the stock drops tomorrow because I know the value hasn't changed. Principles aren't about making you emotionless. They're about giving you a framework so that your decisions are based on logic, not fear, not greed. That's how you stay focused on the only thing that matters in the long run. You ready? The difference between price and value. We want to buy when price is much lower than value. Price goes up and down like this. Value tends to go up like this. So these are the 5 tenets that I use and everybody in our Everything Money community live by. 1, we are investors, not speculators. 2, every investment is the present value of all future cash flows. 3, if we don't understand it, we don't invest in it. 4, in the short run, the stock market's a voting machine. In the long run, it's a weighing machine. And number 5, a great story can become a bad investment if you pay the wrong price. Now, guys, I'm not expecting you to memorize that. I don't expect you to write these things all down. I put together a shortcut for you to make it super easy. A simple PDF that lays out all these 5 tenets in plain English, no crazy jargon, just the exact rules I follow to stay disciplined and avoid emotional mistakes. This guide is your cheat sheet. Guys, you don't need to be a financial wizard. You just need a framework. And that's exactly what this gives you. When prices are bouncing around and emotions are high, pull out the PDF, read through the principles, remind yourself why you're here, to focus on price versus value. And guys, I'll be honest with you, I look at this thing daily. Doesn't matter what the market's doing. So guys, grab the PDF, keep it handy, use it as your anchor. It's simple, it works, and it'll help you make smarter, calmer investing decisions. So click the link in the description, download it, and start using it today. Now, guys, you've heard the warnings. You've seen the numbers. This AI bubble is big. Maybe bigger than anything we've seen before. We don't know yet. And yes, it might burst. Probably will burst. Maybe tomorrow, maybe next year, maybe 5 years from now. We don't know when. But here's the truth. We don't need to know when. We just need to know what to do. Because investing isn't about prediction. It's about preparation. It's about having a process, a mindset, a set of principles that keep you focused when everyone else is losing their minds. Here's what we believe. The best investors don't run from chaos. They use the chaos to their advantage. This bubble could be very, very loud. It sounds very loud. It's absolutely very emotional, and it's absolutely full of hype. But the ones who come out ahead are the ones who stay calm. They stay patient. They stick to what they know. That's how they build real wealth. So yeah, maybe the bubble bursts. Maybe the screen goes red. Maybe people panic. But you will remember this moment. You'll remember that fear doesn't build wealth. Discipline does. So if you made it this far in this video, that's awesome. You're probably on the right track and have the right mentality for getting better at this. You're not just here for the hype. You're here to learn how to play the long game. But guys, this is just the beginning. In this next video, we go even deeper. We're going to break down exactly how disciplined investors like you could have the opportunity to become millionaires in the next crash. Not by guessing, not by chasing, but by following the exact steps that work when everyone else is panicking. So if you want to see the full playbook, the one built on patience and logic, click the video that's on your screen right now. Because when the bubble bursts, you're either going to be prepared or you're going to be part of the story. Which one do you want? Let's make sure you're ready. I'll see you in the next video. Thank you for your time.